Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Friday everybody. Hope you have a restful weekend ahead. We start today's video with the markets. Persistent concerns about the economy and uncertainty in the geopolitical landscape continue to drive a steady exodus of foreign funds from Chinese equities. Chinese stocks extended their poor run this week on yesterday, with the MSCI China Index dropping as much as 1.5%, putting the market on course for a 10-month low. The yuan weakened as much as 0.2%. Hong Kong's Hang Seng China Enterprises Index has shed 2% this week, though of course we note that many capital markets around the world performed relatively poorly this week too. Foreign investors have dumped a further 23 billion yuan, $3.15 billion of Chinese equities so far this month, following a record 90 billion yuan sell-off in August. According to data compiled by Morgan Stanley, hedge funds have increased their bearish bets on Chinese and Hong Kong stocks too, with short interest rising this month across almost all sectors. Commentators argue that the sell-off is yet another indication that Beijing's efforts to restore market confidence are falling flat with markets around the world. There are other considerations too. Quote, "There are still overhangs, such as the prospect of a persistently hawkish Fed and the possibility of a hard landing in the fallout from the property sector, which could keep sentiment low." End quote. Though some contrarian voices argue that perhaps investors are just too pessimistic on China's economy and that equities in the Middle Kingdom are perhaps now undervalued, though still advocating a cautious approach. Quote, "We think the economy has already bottomed. That has been confirmed by data. In terms of the market, what we are seeing is overall sentiment continues to be very downbeat." End quote. And, quote, "Any way you cut it, Chinese equities are cheap. I think the market is taking it very skeptically. Let's see more stuff on the ground that gives us confidence before we start buying." End quote. The CSI 300 index, a benchmark of mainland shares, is down almost 5% this year, after declining 22% in 2022. Next up, regular viewers know that China-based foreign, especially Western and Japanese businesses, have become increasingly concerned about what appears to be an intensifying anti-espionage campaign from Beijing. The push came after General Secretary Xi Jinping chaired a national security meeting back in May, which we covered at the time, which stressed the importance of extreme case scenario thinking. We also recently did a deep dive into the ideology behind this concept. China has since passed a new anti-spy law, accused consulting firms of working for overseas intelligence agencies, and the Ministry of State Security has published popular articles detailing recent arrests of accused spies and calling on regular citizens to be part of the anti-espionage battle. Indeed, over the weekend, China held its 23rd National Defense Education Day, with state-run Xinhua reporting, quote, "Comic strip posters warning of overseas spies were displayed in subway stations. The Ministry of State Security provided information on how to prevent phones, emails, and other devices from being attacked on its newly opened official WeChat account. During the first class of the new semester, schools across the nation offered a special class dedicated to equipping teachers and students to identify and increase vigilance in safeguarding national security." End quote. Perhaps concerned about the effect this is having on global investor confidence, state media this week has produced a series of articles arguing that Western media has misunderstood the recent efforts to combat foreign spying. Here is one example. Quote, "China's recently intensified actions taken to combat espionage have raised concerns among certain Western media outlets who misread it as a witch hunt, that spies are everywhere, and a call to all members in society to apprehend spies. Chinese security experts refute such misinterpretation, stating that China simply aims to gain more public support in counter-espionage efforts, as solely relying on national security agencies is insufficient to combat pervasive overseas espionage forces." End quote. Though it's unclear whether these kinds of statements from state media will do much to calm nerves at foreign companies operating in China. Next up, we have more on the economy. If you're enjoying today's episode of China Update, don't forget to hit the like button. Liking, sharing, and subscribing are all helps for the channel. And for anyone who can go that extra mile and help me keep China Update financially sustainable, Patreon and Buy Me a Coffee links are in the description below. This is a lot of work, but all your support are all incredible sources of motivation. So thank you so much, everybody, for the ongoing support. Okay, earlier this week we did a deep dive into a topic which we've been following closely for months: the issue of local fiscal and debt stress. Since then, Chinese financial media outlet Caixin published a special article on the topic, including reporting on an academic seminar held earlier this month to discuss the problem of local government hidden debt. Today we will look at this report, as well as some other salient information, which should act as supplementary content for the deep dive we did earlier this week on the topic. Caixin, the Chinese media outlet known for often flirting with the line of acceptable criticism within China, was very frank in its description of how acute the growing fiscal crisis is, writing, quote, "China's financial system remains plagued by trillions of dollars in local governments' hidden debt, as they have long turned to off-the-book borrowing to plug funding shortfalls, which have grown significantly due to the pandemic and property crisis." End quote. China's local authorities have accumulated trillions of dollars of liabilities off the books, the outlet writes. They mainly include bonds issued by local government financing vehicles. Debt is also, quote, "hidden in public-private partnership projects, shady loan contracts, and other channels used by local governments to raise money," end quote. A research team at Peking University's National School of Development recently showed that interest-bearing local government financing vehicle debt had ballooned to 54.6 trillion yuan, $7.8 trillion US, as of the end of 2022, from 32.6 trillion yuan just 4 years before, up by an incredible 2/3. Quote, "despite the central government's persistent efforts to resolve it," end quote. And remember, this is unofficial debt. Outstanding official local government debt totaled 38 trillion yuan, $5.2 trillion US, as of the end of July. The head of this Peking University National School of Development research team, speaking at the just mentioned recent seminar, told the audience that if both on-the-books debt and all of the interest-bearing local government financing vehicle debt were taken into consideration, local governments would have had to spend 19% of their total fiscal revenue just paying interest to creditors last year. We remember that a recent US-based Rhodium Group note observed that local government financing vehicle debt has high interest rates too, with the median return on assets for local government financing vehicles in 2022 being just 1%, while interest rates on local government financing vehicle debt averaged 5.36%. The Caixin writers observed that, quote, "interest payment has become more and more challenging for local governments, especially for economically weaker regions, after plunging land sales and 3 years of costly COVID controls drained their fiscal income," end quote. None of this, of course, is surprising to regular viewers. Now we end today's video by directly quoting selected excerpts from the Caixin report. "A major cause for the build-up of hidden debt is that local authorities cannot balance how much they have to spend, including paying for public goods and other investments to grow the economy, with how much they earn from tax revenue and other transparent fundraising channels such as land sales. As the property market is yet to recover from a severe debt crisis, demand for land remains muted. Meanwhile, China's tax-sharing system means that revenue from some types of taxation, including value-added tax, is split between local and central governments, with the latter redistributing the income mainly to poorer regions. Local governments should be allowed to take a bigger slice of tax revenue, while the central government should shoulder more social welfare expenditure. But Yao, here referring to one of the experts speaking at the recent seminar, said that local governments would continue raising debt even if their income levels match their spending burden, As long as a local government longs for economic development, he says, it will take on more debt. To curb hidden debt, Yao's radical suggestion is to integrate all local state-owned enterprises, including local government financing vehicles, into government budgets to put them under lawmakers' supervision. Meanwhile, a contingency plan must be put in place for the real possibility of large-scale local government financing vehicle defaults and the broader financial contagion which such an event would likely trigger. Here ends the direct quote and today's episode of China Update. Thank you so much everybody for watching. Have a wonderful Friday, have a restful weekend, and I will see you all tomorrow.